everyone, and welcome to the beginning of OIC's webinar series for 2020. My name is Ed Modla, the Director of Retail Education at the Options Industry Council. We're going to start things off this year at the basic ground floor level, looking at core concepts of options. We're looking forward to what we have on tap for the entire year, roughly 2 webinars every single month on Wednesdays. So keep your eyes open for the calendar and sign up for those events throughout the year. We've got a lot to offer, and hopefully you can take advantage of that. First of all, our disclaimer: options are unique and involve special risks not suitable for everyone. We're going to be going through some computations today and examples, not including commissions, fees, margins, interest, or taxes. Those are important costs in a live account, but not for our purposes today. Also, a few strategies and concepts and commentary along the way are for illustrative purposes only and should not be construed as an endorsement to buy or sell securities. About OIC, if you're looking for more education, this is where to get it. Our website, optionseducation.org. We have plenty of written educational material, including podcast videos and webinars. These sessions also are archived and put on our website. You can find the events tab on our website, which has the list of upcoming events, and take advantage of the investor services team. Mark, Bill, and Ken do a wonderful job responding to all questions related to options. You can reach them by email at options@theocc.com. Also, those guys are standing behind the scenes answering questions during this presentation, so don't be shy to type in your questions. Every single question gets answered, and if I have time, I'll take a few at the end. Also, we read every piece of feedback that we get, so please fill out the survey and send your comments and your suggestions to us. We look at every single one of those, and it helps us develop and shape the curriculum moving forward. Starting with a broad look at the industry, here are the U.S.-listed options exchanges. This is where executed options transactions take place. And in addition to many other things, each of these exchanges are the ones who make decisions on which securities or which companies will have listed options contracts. There are minimum requirements that these exchanges follow, but they will decide if they would like to list contracts on a particular stock. And by and large, they're trying to continually provide the public with as much material and as much trading opportunity as possible. We're seeing more and more expiration dates listed, more and more choices for the investor. At the moment, there's almost just shy of 1 million unique options contracts that exist, all in the name of getting volume and giving the investing public what the demand is. Speaking of volume, here is an annual look at options contract volume throughout the years. You can see explosive growth as we got into the new century. The 2018 number there set an all-time mark above 5 billion contracts cleared by the OCC. Last year we closed 2019 just shy of that, so the second highest year on record. This year, a couple weeks into 2020, we're off to a very strong start. You see there, 5 billion contracts translates to about 20 million contracts a day. First few weeks here in 2020, we're about 23 million. So with the markets moving, that's good for options volume, and the industry is looking strong. Our presentation outline for today, as I said, it's going to be more basic level, getting that foundation of options knowledge as you're starting to use the product or becoming more familiar with it. I'll have a few words on stock trading versus options trading. Then we'll get into the contracts themselves, the different types of options that exist, the motivations for using them, rights, obligations, contract terms, and I'll finish up with a few examples of different strategies and ways you may implement the product into your portfolio. One example, speculating with options, and another, hedging or using options as insurance. We'll do all of that in 60 minutes or less. And as I said, if there's any time at the end, I'll take a few questions from the audience as well. Starting with investing with stock. Now, this is where most investors are going to begin. Most investors are not going to immediately start trading options right away. They start with trading stock, and it's fairly simple, straightforward, easy to understand. If you buy shares in a publicly traded company, you own a percentage of that company. You have ownership, and along with that ownership comes certain privileges, such as voting rights or dividend payments if that company pays dividends. There's also no time component or expiration date when it comes to owning shares. I'm already starting to compare stock ownership with trading options, but shares don't expire. Now, there certainly could be corporate actions that come up along the way, such as a buyout or a merger or a bankruptcy, where shares cease to exist, but generally speaking, shares don't expire, so there is no time component. Many investors, as they trade stock, will choose to accumulate positions over time or continue to buy more and more shares and build up a position. And it's widespread common practice to have a diversified portfolio of various stocks, watching out for the possibility of having one particular position that is too concentrated that you may need to manage. This can be especially true for anyone who works for a company and has purchased shares of those companies through some sort of employee purchase stock plan. Over the years, that can build up and lead up to be a very high percentage of your portfolio that needs to be managed or addressed in some way. Now, what level constitutes concentrated? Well, that's going to be different for each investor. Certainly, if you're up at that 50% or more level, I think it's safe to say that you're concentrated, but normally you'd say it depends on your comfort level with the stock and the company itself. The more intimate knowledge you have of a stock and its industry and its future prospects, then the higher percentage you might be willing to tolerate in your portfolio. If you're tracking each company and each investment a little more loosely, then you may be looking to reduce your percentage exposure on each one of your positions and have a greater number of different stock positions. And you want to diversify according to your market outlook and also your risk tolerance. Along with that, owning stock can be expensive. It costs money to buy shares, especially if you're interested in buying 50 or 100 shares at a time. There's a number of stocks on the board today that have very high prices on a per share basis, and it may prevent you from ever getting involved in those stocks, even if you like the prospects of that company on a near-term or long-term basis. It's just simply too expensive. Most investors are not going to be shorting stock. So you're looking to buy stock and only have profit potential in one direction when the stock goes higher. If you're looking to manage your position, maybe protect against a downturn, the choice you have when you're trading stock is to fluctuate your cash position and move that cash position higher when you'd like to be more conservative, reducing your market exposure, and then flipping that to be more aggressive, changing your cash position versus your market exposure and somewhat trying to time the market according to your risk tolerance that way. Somewhat limited choices, but also straightforward and simple to understand. You open up a lot of doors when you take trading stock and then implement the options product. There's a lot of different motivations for using the product. They include risk reduction, that's hedging your portfolio or hedging a particular position. Many investors, even at the beginner level, will sell options as a way to improve break-even points, to improve the likelihood of success on their trades. That's known as income generation. You also could try to acquire stock by using the options market rather than your simple market orders and limit orders on the stock itself. And then, of course, you could speculate using the options themselves and not deal with shares of stock at all, just trading options to try and capitalize on a market move in one direction or another, buying for a lower price and selling for a higher price, and just trading options back and forth. I've heard stock versus options described as checkers versus chess. You can teach a young child how to play checkers. It's very simple. Buying stock and trading stock is simple as well. But trading options is a lot more complex, more like a game of chess. You have different pieces, they move in different directions, and you have to think more deeply about when to be aggressive and when to be protective or when to be conservative. And it takes a lot more time and effort and thought to use the options product, that's for sure. but playing a good game of chess is a lot more rewarding than a good game of checkers, and I feel the same way about using the options product wisely. There certainly is a layer of complexity that you add when you introduce the options product, but you cannot get the type of flexibility that options offer with any other product. That's why they're so popular, and they continue to grow in popularity amongst the investing public. Now let's start to talk about options, what they are. First, with the definition, options are contracts that give buyers the right to buy or sell an underlying asset. I'll say that a different way. Buyers of options pay upfront cash, non-refundable, and have purchased the right to execute a transaction in shares of stock. Sellers of options are paid upfront. That's why they sold them in the first place, to get that cash credit immediately. And in exchange for that payment, sellers take on an obligation to execute a particular transaction in shares of stock if the buyer chooses to exercise their rights. The details of that transaction in shares of stock will be spelled out and outlined in the contract itself. The specified price, or the stock price at which this transaction could take place, is going to be identified, and also contracts expire. In contrast to trading stock, options all expire, so there will be an expiration date identified on the contract as well. You might already be thinking that the price at which you can buy or sell stock and how long this contract exists, they go a long way towards determining what the value of the option is itself. The price that the buyer is willing to pay and the price that the seller is requiring to receive is going to largely be determined by exactly what is the price you can execute that transaction in stock in, and how long does that contract exist. We're going to break those pieces out a bit further between the buyer and seller, but first let's just look. If you're trading stock, it's very simple. You can either buy stock and hope it goes higher, or short stock. Most investors are never going to short stock, but if you do, that means you're borrowing shares from your brokerage firm, selling them in the open market, and then at some point later in time, you have to return those shares you borrowed, so you'll be buying them back in the open market and returning them. You're hoping that the stock price declines during that time frame between you sold them and when you bought them back. But most investors are not going to be doing that. You're going to be limited. So long stock is what you'll be doing, looking for opportunities to go long the market, working your orders appropriately. And as I said earlier, fluctuating your market exposure and your cash position to be consistent with how much risk you want to take. When you implement options, what you're really doing is you're adding a whole lot of possibilities to your toolbox. You're going to be evaluating the market, and when the circumstances are right to execute on a particular market move, you want to be able to pull out the right tool. So if we want to look at just some of the choices and possibilities that are available in the options market, by no means is this an inclusive list. There's a lot more strategies that you can use when trading options. And rather than look at the names and try to understand them, just look at the risk profile, each diagram across the board, and you can see some of these strategies have risk that is controlled, others have risk that is not controlled. You have strategies that profit when the stock moves higher, others when the stock moves lower, some that profit when the stock doesn't go anywhere, and I see at least one or two on the board where the stock where the option strategy would profit if the stock moved in either direction. The point is, if you have a market outlook, it doesn't matter what it is. There's going to be an option strategy that fits the narrative that you expect to see in the options marketplace. It's a matter of being familiar with those strategies and then pulling out the right tool. Now let's get into the options and really learn some things about calls and puts. There's two types of options, calls and puts, and you can buy or sell either one of these. So there's four potential trades you can have as outright, solo, individual options trades. You can buy or sell a call, you can buy or sell a put, and that's what we want to break apart here in the coming slides. Now the the transaction in shares of stock that you may have the right to execute or the obligation to fulfill is going to be on 100 shares of either the stock or the ETF that you're trading, and you're going to see that number come up a few times throughout the presentation. So as I said, there's 4 outright trades, and you really have to understand what these are before you can begin to implement the product and use them wisely, starting with call options. An equity call buyer has paid money up front, the cost of the option is paid, and now the call buyer has the right to buy shares of stock. Terminology, if you buy a call option, you are the holder of that contract and you are long the contract. The buyer or holder is also long the options contract. You will often hear economists or market analysts refer to long or short with a market directional opinion attached to that, long being bullish and short being bearish. It's not like that in the options industry. Long the contract does not have anything to do with your market directional opinion. It's that you purchased or you own the contract. Let's think about the motivation here. Buying a call option, you own the right to buy shares of stock at a certain price. Let's say that price is $75 a share. As the stock moves higher and goes from 75 up to 76 or 77, the right to buy shares at 75 is gaining value. It's looking more and more attractive, so the value of the option you own should be going higher, or at least that stock price movement upward is going to have a significantly positive effect on the price of your options contract. And when you buy a call, that's what you're trying to capitalize on, the movement higher in stock price that has a positive influence on the price of the option, so you can capitalize on a move higher in the market without having to buy shares of stock. Let's look at a seller. An equity call seller is paid premium up front. That's non-refundable, goes right into their account. And the equity call seller now has taken on the obligation to sell shares of stock or ETF at the identified price, and they're under that obligation for a certain length of time up until the expiration date. The seller is also known as the writer, or would be have said to written the contract, and is short the contract. Again, nothing to do with market direction. A seller of a contract is short the contract. Most often, investors will already own shares of stock when they sell a call. Think about what this is. You're obligated to sell shares of stock at a certain price. If you own shares, and let's say they've drifted higher, they've gone from 50 up to 55, they're trading 58, you're getting ready to sell shares of stock, one choice you can have if you're just trading stocks at all, you're just trading stocks outright, is to use a limit order and try to sell shares a little higher, maybe at $60. Work a limit order to try to get out of your position. Or you can sell a call option, get paid to do that, and obligate yourself to sell shares at $60, the price you would like to sell shares at anyway. But instead of just working a limit order and waiting for that price to hit, you can sell an option and get paid to wait. Now, there are some intricacies and details that you need to be aware of when you use that strategy, but it's very common to have that motivation and objective when you sell a call. Again, that's owning shares, wanting to sell them at a certain price, instead of using a limit order to do so, selling a call option, getting paid, and obligating yourself to sell stock at a price you already want to sell them at. Now let's flip to put options. An equity put buyer pays money up front, non-refundable, and has paid for the right to sell shares of stock. Just the opposite of calls. The buyer of a put owns the right to sell shares of stock, but the terminology is still the same here. The buyer of the put is also the holder and is long the contract. A couple of motivations that you might have here to buy a put option. If you are bearish on the market, I said before, most investors are not going to be shorting shares of stock, but if you're looking to capitalize on a move lower in the market, buying a put option is one way to try to do that. If you own the right to sell shares at $35, let's say, as the stock moves down from 34 to 33 to 32, the right to sell shares at 35 looks more and more valuable, and you can gain money and profit on moves lower in the stock price by purchasing a put option. Another common motivation to buy a put is to protect shares that you already have. I'll walk through an example of this towards the end of the presentation, so I won't get too into detail now, but if you own shares of stock and you're bullish on those shares, however, you're concerned and don't want to give up too much to the downside, you can purchase a put option, which gives you the right to sell shares, the shares that you own, at a particular price. In effect, that protects your position against a major downturn. There's a couple motivations for buying puts. And then the fourth side, selling a put option. An equity put seller is paid upfront. Cash goes right into their account, and now that put seller is under the obligation to buy shares of stock at the specified price and has that obligation until expiration date. Similar to call option terminology, the put seller is the writer of the contract and is short the contract. Nothing to do with market direction. Is short the contract because they sold it. The motivation here might very well be that the investor wants to buy shares at a particular price, but instead of waiting and watching the market and seeing if the stock gets there, or again, working a limit order to buy shares below their current levels, an investor could sell a put option, get paid, and place themselves under the obligation to buy shares of stock at a price they already want to buy those shares. So that's a common motivation for selling puts. You would need to understand what it means to be assigned and ways to manage the position if you get stock movements earlier than you expected. But by and large, that is a common motivation for selling put options. And those are the four sides between calls and puts. Here's a nice summation of all of that, looking at rights, obligations, calls, puts, and being long or short. This just summarizes everything I just walked through and is a nice snapshot to remind yourself and to help understand and remember where each of these fits in. Now, the entire universe of option strategies and options trades comes from these four pieces. There's all sorts of different ways to combine being long or short calls and puts. You can put two pieces together, three pieces, four pieces. You can choose different expiration dates. You can choose different stock prices at which you can execute those transactions, different quantities. You can buy one of these and sell two of those. There's all sorts of different things you can do. The possibilities are endless, but the foundation is understanding these four sides, then putting them together and utilizing strategies and using them as you best see fit. There is no better way to tailor your portfolio exactly the way you want it than to implement the options product along with your stock trades. So that's calls, puts, rights, obligations, and being long or short. Now, when you're in your platform and you're looking at a contract, you need to understand what you're seeing on the screen, and this would be contract terms, standardized terms. Now, prior to 1973, and 1973 was a big year for the industry. It was when exchanges began to list options, and the OCC, the Clearing Corporation, began to clear options. Before 1973, you could still trade options, but it involved one party calling up another one and negotiating terms between each other and buying or selling a contract together and being tied to one another. That buyer and seller were attached to one another during the life of the contract. Listed options implemented standardized terms. The underlying stock, the unit of trade, the expiration date, strike prices were standardized so that you could now enter an order for a standard contract, execute it on an exchange against a counterparty, but now, since they were standardized and cleared, they were fungible. You could then subsequently close that position, maybe an option you bought before you now want to sell. You can sell it on another exchange against a different counterparty and close your position. That link between the buyer and seller doesn't exist anymore, and it's in large part because of exchanges listing the contract and having standardized terms. So let's walk through an example. This isn't likely the way you'll see it on a screen when you're looking at your brokerage platform or when you're entering trades, but all of these components will be in there somewhere. And we're looking at the XYZ January 15th of 2021 45 strike price call at $2.50. That is the premium amount. That could be the bid or the offer or the value or theoretical value of the options contract, $2.50. Keep in mind that number is quoted on a per share basis. So with the standard contract, as we said, is written on 100 shares. So $2.50 is actually 250 net dollars. Going across the top, XYZ is the underlying. This will be identified. Shares of XYZ stock is the underlying for this option, and it is the stock on which the right or obligation to trade shares exists. You'll also have the expiration date here. It is spelled out very clearly, January 15th, 2021. Your platform that you're using to trade options will likely have some format that they're using to identify this. All platforms will be a little bit different. It is possible that you will not see an exact date. The way this one showcases January 15th, you might possibly not see the exact day. If that happens, it's likely that your brokerage platform is referencing the standard expiration, which is the third Friday of the month. Back in the 70s and throughout the 80s, when options didn't trade as often as they do today, the standard expiration was the third Friday of the month. So it wasn't necessary to put an actual day on there because everyone knew that a January option expired on the third Friday in January. But today, as so much more volume exists in the options industry and the exchange is continually trying to add more and more options to be listed based on customer demand, it is necessary to identify those days. We have Mondays and Wednesdays expiration, we have weeklies, we have leaps, we have all sorts of different expiration dates now, so it is far more likely that you will see an exact date outlined on your platform. And we say the day that the option ceases to exist, an interesting detail, officially options cease to exist at 11:59 p.m. Eastern on their expiration day. That is when they cease to exist. But if you are a holder of an option, make sure you don't think you have up until that minute to decide what you want to do with it on expiration day. If you haven't closed out the position already, then the choice to exercise your option would need to be made by the cutoff time of your brokerage firm, which is likely going to be sometime shortly after the closing bell on expiration day. You'll want to be familiar with the communication rules that your brokerage firm has with respect to exercising on expiration day. So we have the stock XYZ, the expiration date outlined. Also, you're going to have the strike price and the type of option. In this case, the strike price is 45. That is the price at which the underlying transaction in shares of stock can take place at. And then identified somewhere will be whether or not this option is a call or a put. And the final piece is the premium. As I said, $2.50 here. It could reference a few different things, maybe the bid or the offer or a theoretical value or the last traded price. But whatever it is, $2.50 equals 250 net dollars because that premium amount is quoted on a per share basis. I said earlier that a lot of options will get closed prior to reaching expiration date, and that reminds me of a myth that exists in the options market, which I hear frequently, that most options expire worthless. I hear different numbers, 70, 80, 90% of options expire worthless. And that is a myth. It is not true. The Clearing Corporation keeps statistics and data on this. Most options that are opened are closed before they ever reach expiration. In fact, about 70% roughly of all options that are opened are closed, meaning they were bought to open and subsequently sold to close, or the reverse, sold to open and then bought to close before ever reaching expiration, and you can't determine profitability on those transactions because you don't know what the motivation is or what those opening or closing prices are. Of the remaining 30%, you do have the majority of those that do expire worthless, but overall 70% are closed, another 20% roughly expire worthless, and about 10% are exercised. That's what the data has shown consistently from 1 year to the next. Also, for equity options, you can close these positions on any trading day prior to expiration. You're certainly not held till expiration. When you buy a contract, you don't have to hold it, and you do not, from the sell side specifically, you cannot be assigned during trading hours. Some people may wonder, can I be assigned at any time? The answer is no. You cannot be assigned during the trading day. If you have an open position at the opening bell, that position will stay open unless you close it until the closing bell. This was particularly interesting to those who have sold options and are short a contract and no longer want those obligations. Well, if you open the day at the opening bell with a short contract, you have all day to buy it back, close it out, and eliminate your obligations. Exercise and assignment activity takes place after hours during the evening, which means you can only be assigned if you hold that open assignable position after the closing bell. So we've covered a lot there with respect to the motivation of using the product, rights and obligations, contract terms. I want to get now into a few examples showcasing ways you might use the product in a live account, starting with a trade that's going to speculate. Now, you all have to start with a forecast. This is step one. A question I get on a regular basis from an investor starting to use options, they'll ask, well, what's the best option strategy? Which one works the best or works most often? And what they're forgetting with that question is step one really is to have some sort of market opinion or a directional bias one way or the other. Options trades then follow. And I often answer that question by saying that there's a number of different options trades. They will work as advertised, but they all will not work under all circumstances. Of course, you have to start with the forecast. Is the stock going to go up, down, or stay the same? And when you're using options, you also will find it very useful to have further detail. How high or low might they go? What is the magnitude of the move that you might experience in shares of stock? And how long is it going to take for that forecast to occur? If you have those details, you can really put together an options trade, but you don't necessarily need all of those details. And how you form this opinion is also, it's going to be different for each investor. You may use fundamental analysis or technical analysis or a combination of both. Many investors will utilize both fundamentals and technicals if they're determining their market opinion on their own, or you could be using an advisory service. Whether or not you're using any of the above or all of the above, some opinion and some market forecast has been determined. Then you go into your toolbox and you decide, well, first of all, maybe just trading stock is the way to go. But oftentimes you'll see that options can tailor the position a little bit better for you. So let's assume a few things and then walk through the example on the next slide. Let's say that we've done our forecast through whatever method we choose to do so and have determined that shares are going to go higher, and we think that's a near-term outlook. We think a big move is coming in the stock. It's been very volatile. It's been all over the place, and this is going to be a $50 stock, and we really think this thing has hit a major support level, or maybe it's trading at new highs, and it's just going to take off over the course of the next 6 months. So we're bullish. We're significantly bullish in how high the shares might go, and we think within 6 months this is going to occur. There's a number of different ways you can implement that market forecast. As I said, maybe the first one is just straight up buying shares of stock. But if you want to control 100 shares, that would cost $5,000, and we're going to look at these numbers in a second. That's a capital-intensive approach. Using options might offer a better way to capitalize on this move in a more risk-controlled way. So let's take a look at that. Buying or being long one 6-month 50-strike call option and paying $4.50 or $450. Now, before we get to the graph, I'll just say, if this move higher occurs much earlier than we expected, and the stock moves from 50 to 52 or 53 immediately within a couple of days, then the value of this call option very well might be moving up to $5.50 or $6. We might be able to sell this contract right away for a nice profit above the $4.50 that we paid for it if the move occurs right away. But let's just assume, for the sake of argument and the ability to construct precise numbers, that we hold this contract all the way until expiration. You can see on the left side, stock price at expiration is going to be at various levels, and then we start by comparing, well, what if we just bought 100 shares of stock and paid $5,000? What type of monetary profit and loss would we have, and what percentage would that represent? You can see as the stock moves up from 60, we start to make nice gains. We have a $1,000 gain if the stock goes up $10. That's a 20% gain on our total investment. On the downside, if the stock moves lower, we're going to continue to mount losses. That $5,000 is exposed in its entirety. And for each $5 the stock moves down, the profit or the loss will mount by another $500. Down to 40 would be a $1,000 loss, which is 20% of our investment. Let's flip over one more column and look at being long one call option at expiration at the 50 strike. If the stock moves higher all the way up to 60, you can see the profit is $550. Now, real quick, where does that come from? Remember, we're at expiration. If the stock is at 60 and we own the right to purchase shares for 50, that is $10 better than where the open market is trading. There's $10 of inherent value in the position that we have. And we have the right to buy 100 shares. So 100 shares, $10 of inherent value, that is $1,000 that we have in value in the call option that we own. We paid $450 for it up front. That leaves us with a profit of $550. Off of a $450 investment, that's a 120% return. Comparing these numbers, you can see that buying shares of stock would have provided a greater monetary gain, but considering the capital you invested, a much smaller percentage gain. Now, this can work in both directions. It can work for you or against you. This is the power of leverage. The fact that you have control over 100 shares for a fraction of the cost means those percentages are going to be much greater on the option side. I'll point out a negative for the options, of course, starts with the stock going nowhere. If you buy shares at 50 and they stay right there, you've got zeros. You didn't make or lose anything. The option needs movement. It needs movement in the upward direction in a timely fashion and of a certain magnitude before you can start to profit. If it consolidates around 50, we've reached expiration, we lost our options investment of $450. If the stock drops, well, we paid $450 for the option. It can't get any worse than zero. We own something, the value cannot go any lower than zero, so the most we can lose is $450. Notice the percentages there. Even though the monetary loss on the option is much, much lower, it does represent 100%. Some of you may be familiar with options advisors or online services that try to pitch trading ideas, and they will tout the very high percentage returns that they've received on certain options trades historically by buying options, buying calls or buying puts. You can see here, now that's just the nature of the product. Whether it's on the upside or the downside, the percentage gain and the percentage loss are going to be very high. Now, these can be controlled. You can use stop losses. You can watch the market intently and plan on getting out at certain levels. But this is what you are likely to see when you trade options. The percentage returns or the percentage losses will be greater than you would normally experience with trading stock. That's because the money you have invested, the capital requirement, is going to be far less. Now, I want to walk through another example, a different kind of example. The one we just went through, speculating, to be quite frank, it's not easy to profit using options in that way. There's a time and a place to buy options and speculate if you are confident in the directional outlook that you have and the timing and magnitude of that move. Then buying options in one way or another is certainly a possibility. But let's look at something else that might be more common, using options as a classic form of insurance. This is going to involve being long shares of stock and implementing an options contract. You're bullish on a stock in your portfolio, you own shares, you think they're going higher, but you are concerned about a large down move. Now, one thing you can do as a stock trader is watch the market during the day, have the discipline to get out at levels you'd like to get out, or maybe even use stop loss orders. I hear that frequently. You can use stop loss orders to get out where and when you want to. But keep in mind a couple of things about stop losses. First of all, they are not going to help you during off hours, after hours activity, overnight, over weekends, over long weekends. Stop loss orders are not going to work, and things can happen at any moment in time on a micro or macro level. We're talking a fluid military environment, the political environment, the economic environment. Anything can change anywhere around the world, and if the market isn't open, then your stop loss doesn't do anything for you. One other thing with a stop loss, which I'll get to a comparison with options here in a second, but when you're working a stop loss, when the stock trades at that price, you are out of your position. It is closed. You got out at the price you didn't want to see things get worse then, but it's over. Your trade is completely finished. Now, that is one way to protect a long stock position, using stop losses. Another is to use the options market by establishing a worst case scenario, or the lowest price that you're willing to get out of your share position if needed. This is the classic form of buying insurance on a stock that represents a large percentage of your portfolio, that concentrated position, or one that you're just concerned about. You're going to be buying a put option. We'll walk through an example with numbers in a second. You're going to buy a put option on the stock that you already own. Remember what that means. You pay up front for the right to sell shares of stock at a certain price, and you own that right for a certain length of time. Compare this to an insurance policy. It's very easy to understand that way. You pay up front for a put option. That is the premium, just like you would pay on an insurance policy. You choose the price at which you are allowed to sell your stock. If the stock is currently trading at 75, maybe you bought it at 71, 72, now it's trading 75. You want to protect it against a big move lower. You can buy a put option, say the strike price is 70, and that allows you the right to get out of the position at $70 a share. That difference between 75 and 70 is what you're willing to give up. That's the deductible of an insurance policy. How much are you willing to give back or give up before the insurance policy starts to gain value and pay off for you? And there's an expiration date. Insurance policies don't last forever. The length of the policy, how long does it exist, is going to determine what the price is in large part. Longer dated insurance policies or later dated options contracts are going to cost more money. So let's look at this. Stock is trading at $81 per share, and you're bullish. You think the stock is going to go higher. You'd like to keep this long position. You bought stock at 80. It's just moved up a little bit, up to 81. And you think it's going to go to the mid to high 80s, but you're concerned about something happening and the market crashing. So You could use a stop loss here and maybe say, well, at 75, I want to get out of this trade, and I'm going to set a stop loss in at a level of 75. Remember what I said earlier, it doesn't work during off hours, and you're out as soon as the stock hits that 75 level. Another way to protect the position is to utilize the protective put. Go out a few months. Let's say that's the time frame at which you're concerned about. You can choose it, 2 months, 3 months, 6 months, whatever you want. Choose 2 months, you buy the 75 strike put, and you pay $270 for it. That's 3.4% of your total investment. That 3.4% comes from the $8,000 you put up. $270 represents 3.4% that you're giving up of the total investment you put in, which was $8,000. And now you own a put. The big disadvantage of owning a put versus a stop loss is you paid for the put option. Stop losses don't cost you anything. Here, you paid $270, and that's going to decay. You only have protection for 2 months, and then the protection disappears. What are the advantages of using a put option? A couple of things. First of all, you can guarantee that you're going to get out at 75 regardless of when the market moves. That includes after hours and weekend activity. You wake up on Monday morning and the market is down 5, 8, 10% because something unexpected happened. You can feel comfortable knowing that your put option strike price is there. It's fixed. It's not going to change. It doesn't matter if the stock opens up down at $65 a share. You own the right to get out at 75, and you still own that right. If you had a stop loss, you're going to get filled at the best available price at the opening bell. Who knows what price that might be? The put option protects you against that. But also, you have the premium here. You have 3.4% that you pay. Like I said, the put option protects you against the risk that you have during off hours. But then another big level of protection comes in the sense that when the stock moves down to 75, if you're working a stop loss order, you're going to get filled. You'll be out of that trade immediately. If you own a put option, let's say the stock drops down 10%, unexpected news comes out tomorrow. All of a sudden, it's trading down 73, 72. Rather than being out of the trade because your stop loss was triggered, you own the put option. You don't have to do anything for the next 2 months or close to 2 months. You can just sit with the position and wait to see if it bounces. At this point, with the protection on, it doesn't matter if the stock goes down to 65 or 60 or 40. You're protected at 75. You can do nothing. This means you can give your position time to work back in the other direction if you feel like there is that possibility or you have confidence that the stock is going to bounce. If it does drift down to 73, you've still got, say, 4 or 5 weeks left till the expiration date of your insurance policy. You can decide to just sit tight and see if the stock bounces. Maybe it goes back above 75, back up to 80, and keeps moving higher. You didn't have to do anything. It's a big advantage of the put option versus a stop loss. There's been flash crashes in the past when the price of the market or of a particular stock drops very quickly and then snaps back higher. You don't have to worry about getting out of your position at an unfavorable price because you were working a stop loss. The put option protects against that. So like any other investment, there's advantages and disadvantages. When you're comparing two options trades versus one another, or you're comparing stock versus options, you are inevitably going to find an advantage and a disadvantage on both sides. Understanding what those are and then making the right decision is what's important. So back to our example, stock's trading 81. We're cautious. We're up a little bit on the trade. We buy the 75 put. Let's see what happens at expiration. We hold this trade for the entire 2 months. We get to expiration, and we have various stock prices. Now, first of all, on the upside, if the stock continues to rally, this is really what we want to happen. Now, our right to sell shares at 75 is not going to be worth anything if the stock's trading above 75. We're not going to want to sell shares at that level when they're trading at 85 or 90. So the option we purchased is worthless, or you might say the insurance policy we purchased isn't worth anything and didn't mean anything to us, so we just lose that amount. We lose $270. We're gaining on the stock. The total profit and loss as the stock rallies and continues to rally will continue to increase, but it will always underperform holding the long stock outright by the amount we paid for the insurance policy. That makes sense. On the downside, this is where you see the benefit and the comfort level that buying the put option provides. If the stock is down at 70, below the 75 level, that's where the put option starts to gain. At 70, that's $5 below the level that we can sell our shares. That put option will be worth $5 to us. We paid $270 for it, so the net gain we'll have on our insurance policy at that point is $2.30. The long stock is down $10. You see the total profit and loss is down $7.70. So now we're outperforming the long stock position because the insurance has now started to take effect. If the stock moved lower, 65, 60, 50, it doesn't matter how low it goes. The lower it goes, our put will increase in value 1 for 1 with the loss on the stock, and the total profit and loss will continue to be $7.70 no matter how low the stock price goes. And that is the value in the protective put. I think it's safe to say sometimes when you're trading stocks, using a stop loss is the way to go, and other times using a protective put is the way to go. Also, there's a big difference between buying puts on a particular position that you have in shares of stock versus buying puts on your entire portfolio. You may have a number of stocks and be very well diversified, but concerned that an overall move in the entire market is going to crush your investments. If you're concerned about that, you can still use the protective put, but as opposed to going in and buying a bunch of puts on all these different stocks, you can look to an index or an ETF that resembles or you think would perform to a high degree of correlation to your portfolio and simply buy puts on that ETF or index. Certainly you wouldn't be using stop losses in that case. You'd be using put options to buy put options on one particular underlying that would save your portfolio from a major disaster should the overall market sell off in a big way. So I want to do a little knowledge check. We walked through not just what options are, their key terminology and core concepts, also some examples to see how they can be implemented. Again, by no means were these examples meant to be ways investors likely get started or beginning strategies. They're just showcasing different motivations for using the product and how they work. And as I read through these questions, just think about them and test yourself real quick. Buying equity or ETF calls gives the investor the right or the obligation, which is it, to buy shares of stock. Remember, this is key. Buying equity calls or buying any options always provides the holder or the long option holder the right to execute a transaction in shares of stock at their discretion. It is sellers who take on obligations and get paid to take on those obligations. The price at which the put seller is obligated to buy shares, if assigned, is known as what? What is the terminology used here? Again, this could be for put or call sellers, but if assigned, they will need to execute a transaction in shares of stock at the strike price. In the case of put options, that means the put seller, if assigned, is going to buy shares at the strike price. They were paid to take on that obligation. Now maybe the stock has sold off and the put buyer wants to sell stock at a higher level, so the put seller buys them from that other counterparty. The put seller very well may want shares, and that's why they sold the put option in the first place. Let's look at another one. When buying calls to speculate, your profit potential is limited to your premium paid. Is that true or false? And when you're speculating, you're buying options, it's not the profit potential that is limited, it is your loss. The profit potential could be substantial. Your loss is limited to your premium paid. But again, it's not easy to speculate, buy options, and profit. You do need to have the different areas of analysis all lined up. The direction that you think the stock is going, the magnitude of the move that you expect to see, and also the timing of that move. When all those three things line up and you're confident, you can then potentially consider buying options as a speculative move, either up or down. There's other strategies. We walked through one of just buying calls, but when you get more familiar with options and learn different strategies, there's ways to implement 2 or 3 pieces to also speculate on a particular move, but have a little bit more risk control. And the last one here, when using protective puts, the difference between the long stock price and your strike price is similar to what insurance concept? The difference here is the amount of premium, the amount of the dollar amount you're willing to give up as the stock moves lower. How much are you willing to lose before your insurance policy begins to gain value? This is very similar to the deductible of an insurance policy. And you have complete control over what that is when you choose a put option for protection. It is up to you to decide where is that deductible going to be. Similar to an insurance policy, the higher the deductible is, the cheaper your insurance policy is going to be. If you followed that example, that means you're buying a lower strike put option, giving yourself the right to sell shares at a lower level, meaning you're giving yourself a wider range of potential loss. And if you go that route, then the deductible will be greater and the cost of insurance will be less. Of course, on the flip side, if you're looking for more protection, wanting to get out of shares sooner at higher levels, then your deductible will be smaller and you'll have to pay more for that insurance. I want to finish up by leaving our contact information here. Again, please take the survey, send us your feedback. We will look at every single comment that is left for us. Our website, optionseducation.org. Reach out to the Investor Services team at options@theocc.com. That's where they can receive your email questions about options, and follow us on our social media channels. Also, our website does have an events section where you can look up our upcoming events, including next week, January 22nd, our second session of the year. Sticking with the basics, Mark Benzaquin of the Investor Services team will be presenting more on the language of options and core concepts and key terminology. Just a few minutes left, and I know the Investor Services team got to a lot of your questions. I just saw one pop up here. Is options a zero-sum game? If I make money, does it mean that the other guy loses? This question is actually a little bit more complicated than you might think it is. The answer that I'll give, it is not a zero-sum game, because some investors are utilizing stock and others are not. So if you want to isolate just the options trades all by themselves and eliminate all hedging and all other stock transactions, then it is fair to say there's a zero-sum game. If you're just talking buyers and sellers of options themselves, talking profitability in a portfolio, if you make money, does that mean someone else has lost money? The answer is no, because you may be buying an option, profiting on a move higher, and that other investor may have a stock position. They're obligated to sell shares. They've lost money on the option side, but they made money on the stock side. So when you incorporate hedges, stock positions, and options positions, and you really can't separate those two because they're such an integral part of each other when you trade options, then I think you come to the best conclusion on this question, which is that no, options is not a zero-sum game. You can have multiple winners, and that brings up another concept when it comes to another question I may get sometimes: how many trades are profitable? Do a lot of people make money using options? Again, you can't answer that question. Think about the protective put. If you're long shares of stock, you want shares to move higher. You buy a put for protection, and you're actually hoping that you don't need it. That's insurance. No one wants their house to burn down. No one wants to use their car insurance. Same thing with options. If you buy put options, you really don't want to use them if you own stock and you're using the put option as insurance. So you really can't say that that was a loss if their stock moved higher and they didn't need their options contract. Saw a lot of questions come through. Hope they all got answered. If not, the Investor Services team will be responding by email to all your questions that didn't get addressed as they pop through here today. I want to thank everyone for their time. I enjoyed presenting. I hope you learned something. Please review the recorded version of this presentation. If you need to, reach out to the Investor Services team and join us next week as we continue with our basic level education on options.